In the opening weeks of 2026, the silver market underwent a remarkable transformation that distinguished it from most other commodity markets. Over just a 30-day span, individual investors poured approximately $921.8 million into silver-backed exchange-traded funds, creating what market watchers described as the most crowded commodity trade globally. This surge of retail cash into silver ETFs such as the iShares Silver Trust, commonly known by its ticker SLV, reflected an intensity of participation seldom seen outside of major macro asset themes and rare even among precious metals. The volume of retail investment triggered a dramatic acceleration in both silver prices and related assets as investors, traders, and algorithms alike responded to persistent inflows and consequential price momentum. The metric used to describe this phenomenon comes from research by Vanda Research, which calculated that retail investors accounted for nearly $922 million in net inflows into silver ETF products over the 30-day analysis period. In a single trading session, SLV, the largest silver ETF by assets, recorded $69.2 million in retail inflows, marking its second-largest day of retail buying on record, second only to a spike during the well-known 2021 silver rally that was driven by unconventional retail enthusiasm. That event, often associated with meme stock dynamics, has been referenced as a comparison point, but this 2026 surge differed in key structural dimensions. Unlike the standalone speculative episode of earlier years, the 2026 uptrend in silver backed by ETF inflows occurred alongside robust price performance in the metal itself and corresponding equity indices. As of mid-January 2026, silver prices traded near $91.90 per ounce, having risen sharply from roughly $72.62 per ounce at the start of the year, and briefly exceeding $93 per ounce in intraday trading, according to LSEG price data. These price levels represented a new series of highs relative to the preceding year's base and contributed to an environment in which both retail and institutional investors were actively engaged in repositioning exposure to silver. The broader market context underscores the importance of these inflows. The MSCI ACWI Select Silver Miners Investable Index, which tracks the performance of mining companies with significant exposure to silver price movements, climbed approximately 225% over the last 12 months, illustrating that the metal's price gains were reflected not only in ETFs but also in related equities. This synchronization between price, equities, and ETF flows helped cement silver's status as a focal point in global commodity markets in early 2026. Part of the narrative surrounding the 2026 phenomenon is the distinction analysts draw between this rally and the 2021 event. The earlier surge was often described as fueled by collective retail positioning with limited foundational support from fundamental demand or supply shifts. In contrast, the 2026 impulse has been interpreted by some firms as having more structural underpinnings, even while significant retail participation remains a central feature. Vanda Research characterized the trend by noting that silver's accumulation has now surpassed the heights of the 2021 silver spike and that, at least from a trading perspective, silver was being treated as a core macro trading asset, rather than a fringe speculative target. The role of retail traders in driving these flows is notable in several respects. First, the distribution of inflows reflected broad retail engagement rather than concentration in a few large institutional trades. Second, the behavior of SLV, which recorded consecutive daily inflows over extended periods, underscores how sustained participation can shift market structure in a relatively short period. Reports from independent data aggregators suggested that SLV was experiencing one of its longest unbroken series of daily inflow sessions in history, with 169 consecutive sessions of net inflows reported on some platforms tracking ETF activity. The mechanics of ETF inflows matter because they represent physical metal allocation in addition to financial exposure. When investors purchase shares of SLV or similar products, the fund is required to acquire and hold physical silver to back those shares, subject to custodial and regulatory requirements. This means that ETF inflows translate into actual purchases of metal in bullion markets and warehouse networks, which can affect available inventories and spot pricing. The shift of capital into silver ETFs at the scale seen in early 2026 thus had implications for both price formation and the physical dynamics of the silver market. While retail participation was a headline driver, broader macroeconomic factors were simultaneously influencing investor behavior across commodity markets. Concurrent news coverage reported that base and precious metals such as gold, copper, and tin reached new highs in early 2026 in response to geopolitical tensions and economic uncertainty. In that context, silver's rally was part of a wider movement among safe haven and industrial metals, reflecting cross-asset flows into commodities as investors weighed macro risks and dollar strength. The price performance of silver relative to other precious metals is an important aspect of understanding this crowded trade. Over the same period, gold prices also made significant gains, with gold trading near historic highs above $4,600 per ounce at some points, but silver's year-to-date percentage gains exceeded those of gold, highlighting the metal's unique position at the intersection of monetary and industrial roles. As a metal with both a monetary history and widespread industrial applications, in sectors such as solar energy, electronics, and advanced manufacturing, silver's demand dynamics are influenced by a more complex set of drivers than those affecting gold alone. Analysts tracking fundamental supply and demand factors have noted that silver's dual role can affect how price rallies translate into usage patterns. Industrial demand, which encompasses photovoltaic manufacturing, electronics production and other sectors where silver is used for its unparalleled electrical conductivity, has been robust even as prices climbed. However, some market participants have observed that extremely high prices can eventually temper industrial demand growth, as manufacturers may switch to substitutes or postpone purchases when input costs rise beyond certain thresholds. This tension between investment demand and industrial consumption shapes the longer-term context in which the crowded trade of 2026 must be interpreted. The prominence of retail flows in silver ETFs raises questions about market concentration and the potential for volatility. Crowded trades, by definition, involve a large number of participants taking similar positions, which can amplify price movements on both the upside and downside when sentiment shifts or risk factors evolve. In commodity and equity markets alike, crowding can lead to episodes of rapid repricing if a catalyst triggers widespread repositioning. Given silver's recent price trajectory, which saw a climb from the low $70s to the low $90s per ounce in a matter of weeks, the potential for heightened short-term volatility is evident, even as structural factors such as supply constraints and industrial demand provide ongoing support. The dynamics of the SLVETF itself provide additional insight. As the largest physically backed silver ETF globally, SLV's holdings often serve as a barometer for investor sentiment toward silver. In 2025, SLV had already delivered substantial returns, with some analyses reporting gains of 150% over the calendar year, driven by a combination of price appreciation and ETF accumulation. These gains outpaced comparable returns in some gold ETF products, reflecting silver's leveraged response to both macro drivers and investor positioning. Despite these strong performance metrics, commentators from traditional financial institutions have noted that rapid price advances are not without risk. Volatility forecasts for silver suggest that price swings may continue to be pronounced as market conditions evolve, with some commodity strategists pointing to liquidity dynamics in trading hubs such as London and New York as potential drivers of short-term price variation. This observation underscores that while ETFs drive allocation flows, the underlying trading infrastructure and clearing mechanisms also contribute to how prices adjust to demand pressures. The interplay between supply constraints, retail flows and broader market sentiment further illustrates why 2026 has been characterized as a turning point for silver's market narrative. As the most crowded commodity trade, silver illustrates how a relatively modest-sized market can become a focal point for diversified capital flows when multiple drivers converge: retail enthusiasm, macro risk perceptions, industrial demand and structural scarcity signals. The effects reverberate beyond just ETF performance, influencing mining equities, physical inventories, and global benchmark pricing. The interaction of retail inflows with silver's fundamental supply and demand backdrop has been a central theme in market coverage as 2026 unfolded. While retail cash poured into silver-backed ETFs, underlying fundamentals also contributed to the broader price rise, with global silver supply remaining structurally constrained even as demand expanded across multiple sectors. According to analysts focused on the market structure, industrial demand, including critical applications in solar photovoltaics, electric vehicles, electronics, and emerging technologies, represents more than half of total silver consumption, underlining the metal's dual role as both a precious store of value and a core industrial input. This persistent industrial pull has been described as one of the key forces tightening available supply relative to demand, reinforcing price momentum amid ETF inflows. The structural supply picture is distinctive because most silver production is a byproduct of mining for other metals such as copper, zinc, lead, and gold. As a result, higher silver prices do not automatically translate into proportionately higher output, since silver's supply response is tied to the economics and investment decisions of primary metal producers. Market analysis highlights that this byproduct dependency creates a supply-response lag, meaning that even sustained price increases do not reliably expand mine output in the short to medium term. In this context, prolonged deficits near 5 years of consecutive shortfalls have been noted, with global demand outpacing total supply and inventories being drawn down over time, further tightening the market. Retail demand concentrated in ETFs like the iShares Silver Trust does more than move prices, it translates into physical metal being held out of circulation. ETFs that are physically backed must acquire and custodian silver to match shares issued to investors, effectively reducing available open supply in inventories. Recent reporting indicates that SLV's holdings rose substantially over recent years, adding thousands of metric tons of silver to its reserves and placing pressure on available free float in exchange vaults. This diminishes the amount of deliverable metal available to other market segments at the margin, and highlights how large ETF accumulation intersects with physical inventory dynamics on exchanges and in private vaults. The behavior of silver prices also reflects broader macroeconomic conditions. Silver has exhibited a sharp upward trajectory in early 2026, extending gains achieved in 2025, and has at times traded above $90 per ounce, a substantial increase compared with levels earlier in the decade. The metal's performance has outpaced gold on a percentage basis in certain windows, even as geopolitical uncertainty, inflation anxieties, and risk sentiment have influenced investor preferences for tangible assets and commodity exposure. Some commentators point to these macro drivers, including concerns about inflation exceeding central bank targets and safe haven demand in the face of geopolitical tensions, as additional supportive factors for precious and industrial metals alike. However, analysts also emphasize that silver's rally is not without constraints. Unlike gold, whose demand is predominantly investment and reserve-oriented, silver's significant industrial component means that extremely high prices can eventually exert demand destruction in sectors where input costs matter for product pricing. Evidence from industrial users suggests that, at elevated prices, some manufacturers may substitute less costly materials or delay purchases when metals input costs rise above certain thresholds. In solar photovoltaic manufacturing and other sectors, fabricators may adopt material substitutions or modify manufacturing processes to reduce silver intensity, a response that could influence the balance between price and physical demand over time. This dynamic introduces another layer of complexity into the interplay between investment flows and real economy usage of silver. The concentrated nature of the retail trade in silver raises questions about market structure and potential volatility. Crowded trade conditions typically imply a large number of participants holding similar positions, which can amplify price movements in either direction if sentiment shifts. Market commentators highlight that when a trade becomes crowded, even modest negative catalysts, such as shifts in macro expectations, index rebalancing by large institutional funds, or changes in derivative positioning, can trigger rapid repositioning among participants, leading to sharp price corrections or increased volatility. In early 2026, periodic rebalancing of major commodity indices was expected to generate significant selling pressure amid elevated price levels, representing a test of how durable the rally was under technical selling conditions. This illustrates that even as fundamental demand and retail flows support prices, technical factors and market mechanics remain relevant to short-term price behavior. Underlying commodity indices rebalancing showed that funds tracking broad metal baskets might adjust allocations in response to predefined weighting rules, potentially offloading billions of dollars in silver and gold to realign portfolios. The impact of such rebalancing on prices underscores how different parts of the market, retail investors, institutional index funds, industrial users, and miners, interact within the broader pricing mechanism. While rebalancing can temporarily exert downward pressure on silver prices, proponents of the metal's rally argue that structural deficits and sustained multi-sector demand create durable support, counterbalancing technical selling in certain periods. Another component influencing silver's market dynamics is the geographic distribution and regulatory environment of physical supply. Changes to export rules in major producing countries can affect global trade flows and regional availability of physical silver. For example, revised export licensing requirements implemented in early 2026 in China, one of the world's largest producers and refiners of silver, introduced new conditions for companies seeking to ship metal abroad, potentially constraining exports from smaller producers and affecting supply at the margin. Although regulatory shifts do not alter total annual production, they can influence trade patterns and inventories in key consuming regions, adding another layer to supply dynamics at a time of heightened price sensitivity. The combination of fundamental supply constraints, industrial demand expansion, retail ETF inflows, macroeconomic influences, and structural market adjustments paints a complex portrait of silver's journey in 2026. Public data and market analysis show that retail positioning in ETFs accounted for a substantial increase in capital allocated to silver exposure, and that this flow occurred against a backdrop of persistent structural supply challenges. This convergence of demand drivers, across investment, industry, and macro factors, helps explain why silver has emerged as a focal point of global commodity markets and why the term "most crowded trade" has been applied by observers tracking its performance. As the year progresses, participants across mining, manufacturing, finance, and policymaking will continue to assess the interplay of these forces. Whether silver's price reaction remains durable will depend on how supply deficits evolve, how industrial users respond to elevated input costs, how retail sentiment shifts in response to macro signals, and how technical elements such as index rebalancing and derivative positioning influence short-term price behavior. The crowded nature of the silver trade in early 2026 highlights the metal's unique position at the intersection of financial markets and real-world industrial demand, offering a case study in how diverse drivers can collectively shape a commodity's trajectory in a structurally constrained environment.